This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the unexpected just sent political elites into panic mode, and we know the Federal Reserve is desperate for a soft landing because they eagerly want to cut rates and take pressure off the banking system. At the same time, they're hoping to keep the labor market up. And we know the Biden administration is eager to get a second term under their belt. When the November election is looming, they pinned their hopes on bringing both inflation down while at the same time keeping the labor market intact. But of course, it would be a big bonus for them if interest rates could come down as well, taking pressure off consumer pocketbooks. And yet today, the unexpected happened, which just sent both into panic mode. Let's go to Bloomberg, where we picked today's story up with a headline: as U.S. inflation accelerates, tempering the case for Fed to cut rates. And this is a huge problem because the Fed, even though they admitted that inflation wasn't going to come down as fast as they wanted, they were still hoping that the year-over-year rate of change would continue to decline. And today, the unexpected came out, and what we found out is the inflation rate actually ticked up a little bit. Of course, this is a big problem for the Fed that we know wants to go into the next meeting and suggest to the general public that indeed the 3 rate cuts that they had talked about at the last meeting were still on the table. This will put pressure on them to keep rates elevated. Now, one of the problems here is we know in March the Bank Term Funding Program comes to an end, and this means banks are going to face a big problem. We know the Fed wants to cut, but the problem is the inflation numbers aren't giving them what they want. The Consumer Price Index increased 3.4% in the year through December, the most in 3 months, according to the government. On a monthly basis, it also rose by more than forecast. And this is equally a problem for the Biden administration because they've been heralding the fact that inflation is coming down and that they're the ones behind it, giving consumers, again, the financial boost they needed because wages keep holding up. If you can bring inflation down behind, of course, the elections, this gives President Biden a big leg to stand on to trumpet his ability to manage the economy, which right now we know consumers just aren't buying into at all. But there was some good to the report as the CPI, excluding food and energy, rose 0.3% in December from a month earlier. And on an annual basis, the so-called core measure increased 3.9%, which was a decrease from last month. Economists favor the core metric as a better gauge of the trend in inflation than the overall CPI. Well, they factor that because for one simple reason, the number is higher. And even though we have noted in the past on the show that the core rate actually comes down much slower than the headline rate, we know that the Fed has a bias this time of keeping rates elevated as long as possible. This is not going to work out for them in the end, as you're going to see, but for the moment, it gives them every excuse to keep interest rates up a little longer than really the market and consumers want. And here you can see the Consumer Price Index in blue against the core CPI in red. And here's the issue right now. We see this little hook up in the CPI. It's kind of baselining here. And this is starting to put fear not only in the Fed's eyes, but in Wall Street that maybe, just as we talked about the other day, that Jamie Dimon could be right, that this could be the baseline for a resurgence in inflation. Now, you know I made the case why that's unlikely to happen, but the issue here is what people believe. And right now, people believe that inflation isn't going to come down as much as they want, and that's a big problem. The Bureau of Labor Statistics figures show increases in shelter, electricity, and motor vehicle insurance, while used car prices increased for a second month, defying expectations for a decline as consumers look for some sort of relief. Really, the issue here is a lot to do with the shelter component, which in addition to energy is a pretty big factor in the calculation of the Consumer Price Index. Here now we're overlaying in green the Consumer Price Index, the shelter component, and as you can see, it is really high compared to the other two, and it's still coming down, albeit rather slowly and perhaps not fast enough as the Fed would like, and certainly not as fast as the Biden administration would like. But as we get into the details of the report here, well, it actually looks fairly good. And here we can see that the numbers in the print are actually fairly close to zero and heading on the downward slope. We note that, of course, fuel oil has taken a big drop, minus 5.5% month over month. Electricity up a little bit, 1.3%. Of course, that could be an additional factor here. As we note, this big cold front moves through the country. This is going to be an issue as we look forward to discretionary spending. Something that takes that away from consumers' ability is higher electricity costs and energy costs. There is a factor, but here we can note that used cars actually are decelerating here after a big move in November, looking like consumers went out and did some holiday spending. Shelter component still not coming down that fast. Medical care services ramping higher. Maybe people were just a little sick from the holiday season. Who knows, as they look at their credit card bills, maybe they're running to the doctor. Who knows what's happening there, but nevertheless, we're still seeing broadly the trends start to slow down here, which is a good sign, but the problem remains. It's not fast enough in the eyes of the Fed, the Biden administration, or the consumer. And despite the pickup, figures cap a year in which inflation broadly eased without doing much damage to the labor market, setting the stage for the Fed to lower borrowing costs this year, which is the big issue here, is can we get interest rates down and do that at the same time inflation comes down with keeping the labor market intact? And this is going to bring us to our second big surprise story of the day, that something unexpected also happened in the labor market. But I want to show you just how the media, in fact, even the government, smooth this one over. And officials' latest economic projections show they expect 3 rate cuts in 2024, although policymakers have pushed back against market expectations that the first reduction could come as soon as March. Of course, we're making the case that once that bank term funding program ends in March and banks have to start repaying back these loans they took a year ago, one of the challenges is, well, they don't have the money. It's going to put downward pressure on the Fed to bring rates down so the banks can actually sell some of their investments without a loss to repay these loans. That is, of course, the big question mark that looms over the Fed. But one thing that will drive markets higher is the expectation that inflation is coming down and that will bring, of course, equity prices higher as long as the labor market stays intact. Let's talk about an update on our CTA Timer Pro on one of our trades, QQQ. As you can see, back in October on 7th and 8th, we were at this max short level. We started to come off of this. We were buying up the machine positioning. Now, what's unique about our report is it runs a historical overlay. There's nobody else that does anything like this. Of course, our subscribers note that this is the incredible opportunity, is when it comes off max short positions, that's where you want to look to take a buy. You pair that with our Momentum Timer Pro. This looks at all those technical signals. This is something many people struggle with. They don't know, do they follow the RSI or the MACD or something else? Well, we take all those and smooth them out for you. And what happened on October 9th, there was one signal on the technicals after a big sell-off suggesting that the market and the machines and the technicals were headed higher. You would have bought on this green candlestick at open here, and even if you weathered the pullback, which we would have suggested you do, you'd be up 11.9% right now. And as we head into the weekend, of course, our Sunday chart show, we're going to give you some reasons to perhaps even be more optimistic about the equity market, even though what I'm about to show you with the labor market is going to cause some major concerns. But just remember, the equity market follows us, all with a big lag. Because one thing that's going to weigh on the minds of both the Fed and the Biden administration is, of course, the helpfulness of the weekly unemployment claims. Because wait till you see what happened here. You notice initial claims today was reported 202,000, down 1,000 from last week. That was a seasonally adjusted number. But look at this. On a non-seasonally adjusted number, this number went skyrocketed to 317,000. Now, could you imagine how the market might react today if that was a headline print that a bunch of Americans just hit the unemployment line in January? In fact, to the tune of 47.6 thousand more. Of course, when you seasonally adjust these numbers, it all smooths out because we knew that after the holiday season, people were going to lose their jobs. But the problem here, it gets even worse because this report has every marker to give you the indication that nobody wants you to know that the underlying labor market is in bad shape. We noted this in the last episode episode, what did we talk about? Is crude oil inventories get on the gasoline side and on the distillate side. We had 2 back-to-back weekly large product bills. We said that's a red flag in the economy for sure. It tells us demand's going away, and if demand goes away, well, so too goes the labor market. How about this? On a seasonally adjusted basis, the continued claims fell to 1.834 million, down 34,000. But look at this, on a non-seasonally adjusted basis, skyrocketed 202.8 thousand to 2.1 million Americans. That, my friends, is staggering. We're starting to see an increase in continued claims. Now, granted, we expected some of this, but notice that the difference between the seasonally adjusted and non-seasonally adjusted is rather staggering. This puts the total unemployment claims up 63,000 for the week, again suggesting the U.S. labor market is indeed going in the wrong direction. And this, of course, is going to put both the Fed and the Biden administration in panic mode, because they have both pinned all their success on the U.S. labor market staying intact and bringing inflation down. They can bring interest rates down and do all of this ahead of the November elections. And here we are in January, already seeing an increase in weekly initial claims. Granted, it's on a non-seasonally adjusted basis, but if this trend continues and starts to get into the seasonally adjusted numbers, watch out below. Things are going to change in a big way. Of course, the equity market can hold up as long as it believes the Fed cuts, and sure enough, it's going to. As we look at the consumer price index here against the federal funds rate, we can note that there's virtually no correlation other than the Fed usually cuts well ahead of course, the consumer price index coming down. This suggests that even though they're staying on their train here, then they're going to suggest at their next meeting that they're going to keep rates elevated. We know at some point something is going to shift in the eyes of the Fed. It could be some of this underlying data from the labor market. It could see something to do with the banks and the bank term funding program. Whatever it is, the Fed is going to need an excuse to cut. The problem is the CPI today didn't give them one of those reasons at all. And yet we can note that continued claims, particularly now if we're looking at the non-seasonally adjusted number, which we're not here, these are the seasonally adjusted numbers. That means inflation indeed comes down, as we note on this chart, where we see continued claims rising, meaning more Americans on unemployment with less income to spend in the discretionary economy. Well, that brings the consumer price index down. Now, back in the 70s, you could see inflation rising with continued claims, and it wasn't until a lag that it came down. And this is why many people believe inflation goes up as people lose their job. The problem is in the 1980s, well, we became a more global economy, and then things started to change. You'll note that continued claims did go up here in the late 80s, early 90s, as did inflation. And then inflation came screaming down. And then as we went into the dot-com bubble, you'll notice they started to get more in sync with each other. That happened again during the global financial crisis, and it's happening now. And if that's an indication that really 2.1 million Americans are on continued claims, and if there's no work out there for them, this is a huge red flag, because that means demand is going to start going down, which again was validated by the Department of Energy in back-to-back weeks of gasoline and distillate builds. And unlike services, a sustained decline in the price of goods has been providing some relief to consumers in recent months. So I want you to note here that, of course, the media spins this in every possible way. The so-called core goods price, which excludes food and energy commodities, were little changed after falling 6 straight months. So again, they're suggesting that you're getting some relief. But of course, the 2.1 million Americans on continued claims aren't seeing relief at all. And here you can note the real issue behind the report, that this also was changed in the news a little bit. I'll show you here in a moment. The U.S. real meaning inflation adjusted earnings were down 0.2% in December. So by the fact that inflation went up, we actually saw that due to the adjustment for wages, that inflation outpaced wage growth in December. It's not the sign that, of course, the Fed wants to see, and absolutely not the sign that the Biden administration wants to see, suggesting that this uptick in inflation is a much bigger problem than anyone wants to admit. As separate figures on Thursday showed applications for unemployment insurance held at historically low levels last week, notably no mention of the non-seasonally adjusted numbers, while the number of people receiving benefits fell to the lowest level since October. Again, depends on if you look at which line on the report, whether seasonally adjusted or not. And notably, I would think with a big shift and a big deviation between the news, the numbers, the media might pick it up, but notice they completely ignore it. And not to mention, they give you some hope that says despite the fact that December your wages did not keep up with inflation, the Fed is looking for softer labor market conditions to rein in demand across the economy, especially after last week's mostly solid jobs report. The sub-report Thursday showed real earnings advanced 0.8% in December, but from a year earlier, extending a month-long streak in which wage growth has modestly outpaced inflation. And sure enough, it absolutely has. Here you can see average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. This in red for total compensation outpacing, of course, even that uptick in the consumer price index. Perhaps maybe something did change in December that will show up in a future report. Maybe there'll be some downward revisions. Maybe we're going to see hours of work decline a lot. Something is going to change because indeed, if these continued claims numbers are anything close to right, particularly the initial claims on a non-seasonally adjusted basis, this means hours work is declining. That means total compensation is declining. And all of a sudden, the fact that inflation adjusted wages for December did not keep up with inflation, well, that number suddenly becomes very real and a very big problem for the political elites. However, it hasn't been the same boon for Joe Biden. Despite the progress on easing price pressures, inflation has dogged Biden's presidency with his approval rating at similar levels today as it was when the overall CPI peaked above 9% in June of 2022. Voters ranked this issue along with the broader economy of high importance for this year's election, putting heavy pressure on the president to get inflation down, keep the labor market intact, and perhaps convince the Fed that a couple rate cuts wouldn't be a bad deal too. But further softening in the jobs market, as you saw in the non-seasonally adjusted numbers, could undercut the political benefits of slower inflation. Thus, indeed, it's going to bring inflation down in a big way. The problem is, as we've always noted, there's no historical evidence that we've ever had a soft landing, that any Federal Reserve has ever engineered a soft landing, and that, of course, we know that the biggest way to bring inflation down and the fastest is through a recession and putting people on the unemployment line, and we're now seeing the initial signs of that. But now let's talk about somebody and one of the biggest bond experts in the market, someone who interviewed me last year, somebody I'm going to put to the test today and show you why I think he's completely wrong. And that man is Harley Bassman. He says Treasury yield curve is set to return to normal. Well, we're going to agree with him halfway, but I'm going to show you why he's totally wrong. It's done. Stick a fork in it, man. He says the 10s aren't moving, and I think the 30-year rate probably goes up from here as the curve re-steepens again. All the actions on the front end, that's where the action's going to be, suggesting that this, of course, big bond guru is saying that the front end of the curve, that yields are going to go down while the long end's going to go up. I will tell you this, even though I was interviewed by him, this is true. He created all the slides, also factual, did most of the talking. I didn't get much of a chance. What I can say, Mr. Bassman, is you're wrong, and I'm going to prove it. You're going to see when this curve steepens out, which means the 2-year rate comes down below the 10-year, you're going to see mortgage bonds in general go up. You're going to see mortgage yield come down, and you're going to see the retail mortgage rate come down. And the trade that the geeky quants, the complex people, as you might say, are yelling about right now is how do I go and bet on a yield curve steepening? The only question is what part of it is it going to steepen? We're going to agree with Mr. Bassman that indeed the curve is going to steepen. I'm going to show you why it's not going to steepen the way he thinks and the trade he's looking for. Well, he's got it wrong. And here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. We're putting this up here for a reason against the yield curve, which is a 10-year, 2-year, shown in red. And of course, anytime the red line is below the horizontal black line, well, that means the curve is inverted. And what he's suggesting is that after an inversion, it steepens. Well, historically, Mr. Bassman, he's pretty spot on because, well, every time after inversion, it actually steepens. So he's got that right. The question is, well, if he says the long end of the curve is going to go up, the front end is going to go down. The reason I put the banking data on here is because many of these bond experts do not understand the effects of what happens when the yield curve is inverted and what it means to rates. And sure enough, let's take a look here. He says the 10-year indeed is not going to be where it's at. Well, I'll tell you what, the duration is going to be everywhere it's at. And we can note that, of course, looking backwards, during periods where banks tighten lending standards, what happens? Rates on the long end, well, they go down. In fact, you can see that here in the dot-com bubble, the global financial crisis, going into the pandemic, and now he says they go up. Well, what's going to happen is they go down, because when banks constrict the creation of credit in a debt-based economy in order to keep the whole system intact, rates start to fall. Despite the fact whatever investors are doing, rates eventually start to come down in a big way to incentivize one important factor that needs to happen, and that is to get people out to borrow money to create new money into the economy, because if you don't do it, well, everything comes crashing down. And even though Mr. Bassman says buying the 10-year rates is kind of silly, we'll make the case why he's going to be completely wrong, and rates are going to come down. If the front end goes down, the long end's going to go down. He says if you're going to buy this and go do this theoretical insurance policy of the Fed doing massive cut because of a hard landing, you want to buy the 2-year. No, the answer is you want to buy the long bond, Mr. Bassman, because if you understand duration, and I know you do, well, as we already showed you, when the Fed starts to cut, they cut in a big way, and we know the Fed has been at zero twice in a row. So the odds are the next time the Fed begins a cutting cycle, we're headed back to zero and somewhere on the way to negative. That means the intermediate and long end of the curve are going to put up some massive returns. And who agrees with me? Well, PIMCO. As PIMCO predicts equity-like returns from bonds even after the rally, suggesting that they disagree with Bassman too. And I can't blame them, because if the current economic conditions persist, bonds have the potential to earn equity-like returns based on today's starting yield levels. In the event of a recession, bonds should outperform stocks. Well, that's a given. They do that anyways. And even if inflation resurges, which I've made the case is unlikely to happen, high starting yields can provide potential cushion for bonds. And PIMCO expects the Federal Reserve to begin cutting rates by mid-year, and eventual return to are slightly higher than the pre-2020 levels. Of course, PIMCO, I'll one-up you and say rates are headed, Fed and funds rate are headed back to zero, and the long bond is going to be somewhere close to that as well. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.